Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I hope your weekend was kind to you and you're feeling all refreshed. It's going to be an interesting week for markets, particularly with that US inflation data out later in the week. I continue to suggest the headline inflation should go as the market wants, but that core inflation could disappoint again and hold up quite firm. Should be down a little bit, but the fact is that core inflation number hasn't come off its peak the way the headline data has. So that will probably be the mainstay of the week in terms of economic data. Over here in Australia, though, I just wanted to draw your attention to the little Australian dollar. There's a little bit of an economic fundamental outlook battle going on, if you like, between the United States and Australia on the currency front, from my point of view at least, in that the Australian economy is most certainly headed into recession. And if I get that wrong, it'll only be by the slightest of margins. We're seeing retail sales fall, a whole lot of other economic data really pointing to the downside. Property prices seem to have stabilized. That will help consumer sentiment, but they're not rebounding in the way that they fell. And therefore, you know, there's still a lot of homeowners out there, and some studies put it as high as 10% of mortgage holders are currently in a position of negative equity. In other words, if they went to sell the home that they bought in that post-COVID boom, now they would find that they would get much less than they paid. And in many cases, this means that people have lost their entire life savings, which is a massive tragedy because people work so hard to save up that deposit for that property. So even people who've had a 20% deposit put down, in some cases in some suburbs in Sydney, most certainly, and I think this could be the case in Melbourne as well, they're still in a position of, if they were to sell now, you know, they bought the $600,000 apartment, it's now worth $450,000. The real estate agent saying that's the best they'll get, according to one news story. And, you know, they put in $150,000. So very difficult times for a lot of people out there if they were forced to sell. What seems to be happening is people are trapped. So in other words, they're going to have to continue to work to pay the mortgage on a property that really isn't generating a return for them and is in fact generating a loss. So very difficult environment for many consumers out there. And I do think that the Australian economy is in trouble for a range of reasons, not least of which, of course, is our still deteriorated relationship with China and China's stated public policy to look to get commodities that they currently get from Australia from elsewhere whenever they can. So that's not a positive situation to be in with our biggest trading partner. On top of that, we also have the Chinese economy, as we all know, already in a manufacturing recession, and the overall economy is still to find where that airport is exactly in terms of a soft landing for this slowdown. So some downside risks in the external world, and that's just China, but of course the United States is slowing, I'll come to that in a second, but Europe still in the midst of war, and that war is having a psychological impact on consumers and businesses alike. And it is retarding economic growth there. In fact, we saw European retail sales come out and contracted 0.3% last month. So the global economy is still slowing. And we saw that, remember I highlighted in the Chinese export data that it suggested the whole world was continuing to slow in demand. That seems to be backed up with the economic data out of the United States showing still in recession there for their manufacturing sector as well. And we know that Germany and Italy are really flirting with recession as we speak, two of Europe's major manufacturing nations. So not a good outlook for global manufacturing, therefore, and that's because the global economy, as in demand, is already slowing. So it's not the cause, it's a very strong indication that global demand continues to slow. Now, for an export trading country like Australia, that's not good news. So the external sector is very worrisome, and there are still problems with interest rates as high as they are in Australia at the moment. It was good to see the RBA stay on hold. They should stay on hold. They shouldn't be raising interest rates again, but that doesn't mean that they won't. And from their playbook, you would think that they would be raising interest rates again, the way they speak about the economy and inflation in that very blinkered, simplistic way of theirs. So still high interest rates in Australia, still hurting consumers, still high prices in consumers for consumers to carry. Sure, inflation has come down, but the prices haven't come down. Well, they have they have a little bit, but overall the consumer is still weighed down by prices for goods and services especially that are way higher than they were immediately post-COVID even, let alone before COVID. So a lot of stress is coming to bear. And of course, I always spoke about from 2 years ago, I remember started to speak about this, how there would be a valley, an economic valley into which Australia would fall post all of that government stimulus and interest rates for too low for too long period that the RBA delivered Australia. So that was the RBA's big mistake, not that they hiked rates so much, but they wouldn't have needed to hike rates that much to fight inflation if they'd listened to us 2 years ago and started steadily hiking in small increments. So all of that said, Australian economy is already slowing, and I expect that slowdown to be deeper than most other economists. So do be prepared for further downside risk on the domestic economy and the external sector for Australia at the same time. And Australia rarely experiences that. It's usually been saved from its own errors by the strength of the Chinese economic boom, but China has matured now. So that benefit isn't going to be as great going forward. And so we need to manage our own economy much better than we have in the past. And that isn't happening as yet. So with ever higher energy prices in this country, especially for households, up near the highest in the world, and we're an energy exporter, go figure that one out. So that's a problem to do with policy. Australia's domestic policies are not world's best practice. We need to lift our game. All of that said, you know what I think of the United States. It's falling in a hole. It's going to flirt with recession as well. So in terms of economic fundamentals, excuse me, in terms of economic fundamentals, which currency would you rather hold, the Australian dollar or the US dollar? Well, I guess it's going to be determined then by which way the US dollar tends to shift overall. Long term, major US dollar bear, 10 to 15% lower. Over the next month or two, not so sure. There could be some further major US corporate bring money back home, major US fund managers bring money back home effect as their own economy slows and they become more fearful. They will bring money back from overseas, and that will support the US dollar. Also, the long end, the bond yield, I enjoy selling the 10-year bond in price, as in yield will be going up, because I think that's a major trend still to develop. So even though the Fed stopped raising interest rates, there's still more interest rate pain in the United States. The US economy will slow further. Fund managers, corporations will become more fearful. They will bring more money back to the United States that can support the US dollar. So for the moment, it's very tricky here, but I would suggest you have a very clear range for the Australian dollar US dollar relationship at the moment. On the wide, that's 65.10, 66.10. On the narrow, if you want to be aggressive, I'd be watching 65.50 to 65.95. So that should kind of be the range today. We start to see a break out of that. That would be an early warning that maybe we're going to test that wider range that we've seen over the last week, in which case I would go with a break in either direction, actually. I tend to think it will be to the downside, but I would go with a break of that range in either direction because the United States also has its own troubles. I hope that helps. Clifford Bennett, Chief Economist, ACY Securities. Thank you very much.